the lender is really the one that's making the decision. The lenders just aren't necessarily in the business of being able to do that work yet. And then they'd rather see the workout happen before it gets to them. So they rather see, okay, well, hey, let me put pressure on the current sponsor, get them to sell and move on versus the process of having to foreclose and then
Right.
take over and then, find a new manager. By the time I've done all that, I've probably destroyed a third of the value of the property. And so they want to see it worked out at the sponsor level. And they want to see it clear the market in a normal transaction. Once the deal goes to the lender, nobody's paying that price anymore, right? Everyone knows, oh, different economic situation, different, incentive structure. And so most of the time I'm talking to that, but a lot of times I'm talking to the sponsors and they think that they can sell a deal at a price and, I just have to, and I know that they can't, and I know they can't raise any more money on the value of the property that they have. And I know that, in 3 to 6 months, that deal is gonna be with the lender because they just don't know what they don't know, and they're sort of people can be a little delusional sometimes all the way up until they run into the brick wall.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Michael Pouliot. Michael is a fourth-generation real estate entrepreneur and the CIO at Carbon Residential, where he focuses on workforce housing in high-growth Southeast markets. And in just a minute, we're going to speak with Michael Pouliot about the 2026 Multifamily Marketplace. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe, and as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Michael Pouliot. Welcome to CREPN Radio.
Thanks for having me. I'm looking forward to our conversation.
Well, I'm delighted you're here, and I'm looking forward to our conversation as well. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure, yeah. So my background is, as you mentioned in the bio, my family has sort of a real estate family. So I've been working in kind of the real estate space since I could legally work, or maybe a little bit before then. And then, from a education perspective, I got my degree in finance and moved into financial services, worked on Wall Street. And then meandered my way over to financial consulting, M&A, workouts and bankruptcies, and then finally found my way back to I guess the family business in a sense, not necessarily a family business, but the real estate industry, and started acquiring property about 10 years ago. And, I'm sure we'll get into, the progression of all of that. But that's now I do that full time. I've been doing that for 10 years with my business partner, Cody. And and I've got 4 kids, a couple of them you can see right behind me. And I'm married to my wife. It's been going on 13 years. And we live in Boulder, Colorado. So, yeah.
Awesome. Well, your background sounds like you were kind of born into the real estate business there, and that's interesting. I'm kind of curious, as far as your family goes, was there a particular asset class that your family was invested in?
Yeah, so every generation sort of found themselves in real estate, but didn't necessarily build something that was, that stood the test through generations, right? So, um, which I think is nice. Everyone got to kind of do their own thing and choose their own adventure a little bit. So my father is, and he's kind of retired now, but a real estate developer, mostly, especially in the last 15 years of his career spent his time building luxury single family homes along the coast of New Jersey, mostly second homes and things like that. Really nice products, but he's done mostly housing, mostly new construction, suburban development, and then individual homes. Going all the way back to the 80s to now. So a long career. And that's where I would, have been, I was digging holes and grading things and going and picking up toilets and fixtures and, those sorts of things that don't require too much skill to do, but just energy basically. And also my grandfather, my dad's father, he worked as well with my father and did a lot of like foreman, sitting at the job, all the way until his 80s. Basically, he would be a foreman on my dad's projects and things like that. And but he was also in, he worked for the city and built firehouses and police stations and was more municipal type of a thing. And after, he took that up. Now we're going back quite a bit, but he was a Marine in World War II, and then as he came back, he went into that business, working for the city. And then on my mother's side, it's same type of thing. Housing, still been housing, some mixed use and some office. But that would have been in, the 1950s, 60s, back when New Jersey was just all green pastures, and now it's turned into the most densely populated state in the United States. So yeah, that's I guess yeah, mostly housing and some mixed use and office in the history, but I've been exclusively in the housing space for my own career.
Got it. Got it. And you said you've been in the investing for 10 years. Is that right?
Yeah, yeah,
Okay.
yeah. Mhm.
What's your strategy? Or what's kind
Yeah.
of the lane you guys run in?
Yeah, so I mean, I think yeah, the zeros at the end have gotten bigger, but generally the same strategy. We're usually looking, even from that first project. The first project I bought was a single family row home in Philly. We were living in New Jersey at the time, and so I bought a 1,000 square foot row home, two bed, one bath for about $25,000. And it was all bombed out, in terrible shape. Did the whole renovation, probably spent about $40,000. And then, refinanced that back out, rented it, and held it for a few years. And so that strategy of doing some sort of physical improvement to the project, buying at a great price, finding a good opportunity. That's sort of the same thing we're doing today. Just, instead of 25,000, now the deals can, be 25 million. But essentially it's the same principle. We're looking for property in areas with great schools, strong income, low crime, and looking for properties that are typically for the median or lower than median income in that area, which is usually going to be say 60 to 80,000, maybe 60 to $90,000 income. So we're typically giving people or having situations where rent is $1 a square foot, $1.30 a square foot once we're renovated. So pretty affordable rents, good hard product, good soft product. We run all our own properties, and yeah, so and it's the same strategy. We buy it for a good price, we add value either through construction related physical improvements, or more recently, a lot of our work has been around operational improvements and less physical. A lot of operators who have properties that are not performing very well, and we're able to come in and really add a lot of value just by applying best practices and consistency across the properties. So yeah, that's what we're doing today.
Got it. And as far as the model, are you kind of a buy and hold, or are you doing the value add and exit and get on to the next one, or what's your
Yeah, so one of our core values is taking the long view, and we definitely look at that from the investment perspective as well. And so all of our deals we forecast a 10-year hold. And if I could manage it, I would never sell a piece of real estate that I own. But of course, where there are situations where we have investors who want liquidity, we can always recapitalize deals. But the underlying real estate, if we're buying what I would consider to be uh, unique assets that cannot be, only you can only buy them once a cycle. And so once I get them, I don't want to let them go.
Got it. You mentioned investors. Are you guys, do you have partners? Are you doing syndication, or do you have a fund, or what are you doing
Yeah.
there?
So we have done mostly syndication, deal by deal raising. We did raise and deploy a fund over the 2024 and 2025 kind of year vintage. So that'll be really great long term. I think pricing and the opportunity set over the last few years has been really strong on the buy side if you can find opportunities. But mostly it's usually we have some sort of fund vehicle that will take some of the deal and then we'll raise the rest deal by deal. Some investors like the fund, other investors like to see the deal before they write the check. And so we like to have both options for people depending if, what their, favorite ice cream flavor is.
Yeah. So total assets currently in your portfolio, what are we looking
Yeah,
at?
we're somewhere just shy of 3,000 units right now across uh, you know, Texas, Arkansas, Georgia, Alabama, and Florida.
Okay. And did I hear you say you are vertically integrated, or do you
We are,
manage?
yeah, we're
Okay.
vertically integrated, so we run all of our own properties all the way, we do all our own marketing, all our own construction, um, all our own recruiting and HR, everything is in-house. And we're continuing to look for opportunities where we can bring more and more and control more and more of the stack.
Got it. And for the properties, the 3,000 units, what give me a sense of the size of number of units at any one property?
Yeah, we have one asset that's 40 units. Everything else is between 100 and 300 units. So it's our typical property is your garden style vintage apartment complex built in the 70s to the 90s. Usually two-story, no elevator. There's usually good amenities, either because they're already there or because we put them in, mostly family focused type amenities. And yeah, but pretty typical type of product.
Got it. And you mentioned kind of the the 24, 25 timeline. Um, were you seeing, prices, for a buyer? Because I mean, I guess let me kind of reset this. One of the things that I think kind of forces the issue in commercial real estate is the financing, where you have kind of timelines where the loan matures. You've either got a refi or, the rate resets,
Hmm.
kind of thing. And then you have investors, you mentioned, and not all investors want to stay in the deal forever. A lot of them want their money back, which creates these natural cycles. Are
Hmm.
you seeing kind of the opportunity based on some of the low rates that people had that are as a reset that are creating the opportunities, or are you seeing people that are just tired of being in real estate? Tell me a little bit about the opportunities you're seeing.
Yeah, right now in our space, I would say there's no one who's selling if they don't have to. So typically these are going to be, yeah, it's typically debt driven or liquidity driven. So they've held on as long as they can. They probably bought at a price that most certainly does not make sense today. And they probably put a bunch of money in. And for operators, I mean, even operators who deployed the capital, got the value add, did everything right, grew NOI 30, 40, 50%, they're still just treading water, right? Relative to where we are today, just because rates doubled and, and cap rates, which, cap rates are just the way that essentially we value the property. The cap rates have essentially gone, I wouldn't say double, but they're up 30%, 40%. So, and it's very linear, it's a linear type of a relationship. So, if NOI goes up 40%, but the valuation metric goes up 40%, your value didn't really move. But you did a lot of work and you have a better asset, probably have a better tenant base, and you're making more money per unit. But a lot of that money, all the additional money is going to your debt. Um, so we see that as an opportunity, especially on the buy side. And but the situation is that if you want to buy something today, and you want to get that good deal, you're not just buying easy peasy deal, right? If someone ran out of money or they're at their loan maturity. Their final loan maturity because they probably extended once, they extended twice, and now there's just no more extensions available. They're zero. They're the promoter, the person who's running the deal, even if they're still doing. Sometimes it's the debt is already. We're talking to the debt holder at this point. But they're exhausted. They have no economic interest in the deal at that point. A lot of them don't necessarily see themselves with a future in real estate, so they're not that concerned about that problem of reputation. And so they're kind of and that reflects in the operations, and they sort of just take your eye off the ball and kind of give up or whatnot. So that means that we can typically buy at a great price, a good valuation, but we got to do some work to make the value. But I think that's the thing. That's what real estate's all about. It's not really about, free money and, prices just going up for no reason all the time. You want to buy the deal at the right price. You want to operate it well, and you want to improve the asset in some way. And that's what deserves the return. It shouldn't just be on the basis of, the Fed giving us easy money. So yeah, I think for people who are operators and now is the time, and it's been the time. It's just difficult to find deals that will work with sellers that are willing to sell or can sell.
Right, right. I'm curious. You mentioned, obviously the sellers that have to sell, but you mentioned also that sometimes you're talking to lenders. Are you finding, I mean, or is there a percentage of the number of opportunities you're seeing that are bank conversations versus seller conversations? Can you?
Yeah, I mean, I would say that a lot of the times I'm still talking to the sponsor, um, but the lender is really the one that's making the decision. The lenders just aren't necessarily in the business of being able to do that work yet. And then they'd rather see the workout happen before it gets to them. So they rather see, okay, well, hey, let me put pressure on the current sponsor, get them to sell and move on versus the process of having to foreclose and then
Right.
take over and then, find a new manager. By the time I've done all that, I've probably destroyed a third of the value of the property. And so they want to see it worked out at the sponsor level. And they want to see it clear the market in a normal transaction. Once the deal goes to the lender, nobody's paying that price anymore, right? Everyone knows, oh, different economic situation, different, incentive structure. And so most of the time I'm talking to that, but a lot of times I'm talking to the sponsors and they think that they can sell a deal at a price and, I just have to, and I know that they can't, and I know they can't raise any more money on the value of the property that they have. And I know that, in 3 to 6 months, that deal is gonna be with the lender because they just don't know what they don't know, and they're sort of people can be a little delusional sometimes all the way up until they run into the brick wall.
Yeah. Well, and it's interesting too. You mentioned kind of the lender's perspective. I mean, while we all remember you know, the cycle where all the banks had all the assets and you know, were forced to well, not even that. I mean, that whole cycle is kind of a weird cycle with it back in the I guess it '08? Was that the big crash? The or I don't know, called the Great Recession or whatever that was. But the where the banks were plied with cash and trying to peel off deals and trying to reset the market, and then we've had the great run up. But kind of, I guess what I'm hearing you say is it sounds like the banks have learned a little bit in that we don't want the asset back, and let's try and make this happen before it gets to that, which
Mhm.
saves some of the value there. That's encouraging. I guess I don't know if it's encouraging, but it's interesting to see that that's where they're at, and it would seem like that's a wiser decision on their part.
Yeah, well, I think also the cycle's a little bit different this time with what's going on. There's plenty of liquidity available in the market from at least a debt side. Certainly equity is a little bit more resistant to the space, but in certain circumstances, but debt is very available. And so I think in the financial crisis, debt was not that available, and so it was very difficult to and there weren't as many non-bank like there's just different types of lenders out there now that can do they can extend, they can modify, they can do things. I think when CMBS isn't as a type of a loan isn't that modifiable, and so there was a lot more of that. There was a lot of just different types of debt, and so I think that plus, I think it's more of a situation where values have gone down, and I think you can maintain positive carry, right? And so like you don't have to necessarily feed the asset to survive. I think in the financial crisis, there was a lack of income. And so people like they just ran out of money, and so the lenders had to take back these unproductive assets, and there was very limited credit availability, and so we're in kind of a different environment now. And it's definitely a struggle, and it's probably definitely the worst, it's been for certain real estate sectors since '08. But it is a little bit of a different composition.
Got it. With the lenders you're speaking with, are any of them interested in being your new lender?
Yeah, yeah, no, definitely. Lenders are definitely lending. There's bridge debt available. There's obviously agency financing is always available for our product type, workforce housing. It's the whole reason Fannie and Freddie exist is to provide workforce housing. Well, that's their stated mission, is to provide workforce housing and continue to maintain and improve the workforce housing stock in the United States. Um, and so there's always that capital available. There's tons of debt funds. Debt funds are back in the game. And so are, CMBS, insurance. There's just, there's a host of debt available and at much better rates than just a couple of years ago. So yeah, the market is open for business. It's just that, yeah, getting inventory that you can find a common ground between a buyer and a seller can be tough right now.
Got it. Got it. And I guess what I was just trying to clarify, and it's probably not as direct, because some of the larger deals you're dealing with, what kind of a price range are we talking?
Yeah, so most of our deals are going to be between 10 million on the low end to say 30 million, maybe 40 million on the high end. And so with those size deals, we're typically our go-to would be agency debt. We prefer to take on 5+ year fixed rate debt at relatively low leverage. We are restricted internally by our investment committee to a certain leverage point, and so typically we aren't able to take the amount of leverage that lenders will offer. But we find that to be we'd rather be in that situation. But yeah, no, there's tons of availability of debt. And maybe maybe a little bit different in the smaller space. I think rates, especially, for instance, in the larger space that we operate in, we can get although rates have moved quite dramatically recently. Recording this in the beginning of June of 26. We can get, a 5.5% interest rate with 2 or 3 years of IO on a 5 to 10 year term. And, just 60, 90 days ago, maybe a little bit longer back at the beginning of the year, we'd be at 5% or maybe even a little below 5%. Availability, but if you're in a smaller space and maybe you're looking for a $5 million loan, you might see a rate another 100 basis points above that, right? A 6.5 or 7% rate which makes it very difficult to make things work sometimes in today's market.
Yeah. No, you mentioned did you say your loan committee or you mentioned
Investment
something?
committee, investment
Investment
committee. Yeah,
committee.
yeah. Mhm.
So what are the lending parameters that you like to stay within?
Yes. So, and this is something that we are always looking at our existing book of business, how we do business and where we can mitigate risks. But one thing that definitely we know mitigates risk that we have installed and is a requirement is we cannot exceed 70% loan to cost on our project. So that's including our CapEx and all our closing costs, et cetera. So that means for a $30 million capitalized deal, we're bringing $10 million of equity, 20 million of debt. And so now that is a typical structure for us is 2/3 debt, 1/3 equity. So that's one. Two is we like to have a significant amount of unallocated cash reserves. So that's another piece of the kind of leverage pie. So even though we bring say that 30%, we also need to have about 10% of the capital structure in cash reserves. That's usually unallocated. So that's not for our construction budget or anything like that. We want to make sure that if something goes wrong, we don't have to ever go back to investors or God forbid have to sell at a loss or at a time when we don't want to sell, like right now, right? So we find that having cash is king in a lot of ways. It gives you a lot of optionality. So we like to maintain high cash. And that's a requirement in each one of our deals. And then we have probably another 150 data points that we look at as it relates to the local market. I had talked about schools and income and crime and population growth, employment concentration, that all that sort of thing, commerce. So we're definitely looking at all of those factors a bunch of different ways, down to the 1 mile radius, the zip code. We're slicing it from different sources. And we also try to concentrate our properties in areas we already know really well. So we typically have a really good sense of, because we're usually a couple miles away already, on another property. So we need to have a good sense of our revenue potential, what the product needs to look like to attract the investors. And, we already have all of the vendors and everything that we need to execute the project. So that's a big one. And then on the property level side, we have a lot of different metrics, but we are family focused. So we are looking to attract and retain families because we are focused on school districts and families. We tend to see much longer duration tenants because they want to stay through that school experience for their kids. So we're looking to suit their needs: 2 beds, 3 beds, typically 2 bathrooms at least in a 2 bed, or 1.5 bath in a 2 bed, or even 3 bathrooms in a 3 bed. People don't really want to fight over one bathroom as a family. So that's a big factor. And that typically leads to a bigger size unit. So we're typically looking at larger average unit sizes than typical. And because of the school requirements and whatnot, we're typically buying older assets in very established neighborhoods where new supply is not an issue. There's nowhere to put a property. Each house might be worth $500,000, so you're not gonna level a block to put up a multifamily property and compete there. So yeah, those are a lot of the things that we look at as a committee, and then also just as we're evaluating deals from the front door, right? Like if they don't pass some of these screens, we don't even really get very far in the process before it even gets to committee.
You mentioned kind of the makeup there, the 2 baths. I mean, I'm a big fan of that, especially when you're going with the larger units. But I'm curious the vintage You talked about being in kind of pretty established neighborhoods with good schools now. Is there a particular kind of a sweet spot as far as year built that you
Mhm.
find kind of the range that fits your model?
Yeah, so by by the function of the neighborhoods that we look for, a lot of the building was done in different times. And so, meaning it ends up being, the 70s and 80s construction properties tend to be the properties that are in these areas that have these really good schools, low percentage of people who are renting, high ownership, high accountability, and things like that. And um, so that ends up being what we end up owning right now. We would like to. We're not married to older vintage properties. Is just a function of the properties that are in the areas that we are buying. That's typically what we're seeing. I would say that, older properties certainly come with their challenges, but I don't think I think you're well compensated for the additional risk, assuming you make sure you account for it. Obviously, if you ignore the risk completely, then you're not being compensated for it. But if you know what you're doing and I think we've purchased, 5,000 plus units that have been 70s or older. You just know what you got to look for, and you just, it's like nothing else. If you were buying 2000s vintage, you would have another set of things that you would be looking for. But we find, especially when the market is, and we did a study on this actually on the vintage perception. What we found is that when the market is cool, when people are kind of soured on real estate, it is older vintage properties are in the are kind of discounted. And so you can buy them at a much better price relative to their newer vintage peers. And that as the cycle gets hotter and hotter, the spread between older vintage and newer vintage collapses because everyone's like, everything is great. It doesn't matter. Revenue is revenue. Buildings are buildings. As long as I can show a pretty picture and raise the money, we'll do it, right? And that's the mentality when the market gets hot, right? It's like, stamps.com, right? Well, you just like, if it has a good ticker, people are going to buy the stock, right? And that's kind of what happens. People get less discerning. But when people are just very discerning and there's less liquidity, we actually find that we can buy these 70s products for a really great price, sometimes half of what we can buy per square foot of a property that's built 20 or 30 years newer, that is in a worse area, that doesn't have more revenue, doesn't cost more to operate. It just, has different
Yeah.
building materials. So,
Well, and I like your whole thesis there with, and I think one of the key things that I'm picking up on is you have your percentage of leverage is key, as well as your hold time. You're not
mhm,
beholden to some sort of a quick exit. I think I've been doing this podcast since I think we started in 14, maybe 15. But in any case, there was a lot of early syndicators that were all about just just get the deal, and because of the way the lending cycle was, a lot of them could get out of the deal well ahead of their planned exit because there was
mhm,
somebody else wanting to get in, right away,
mhm,
and it was all
mhm,
that kind of a false, kind of a bastardized market from a standpoint of when the Fed really monkeys with rates like that, it doesn't really. I mean, it happens, and for you know, cycles are created by. I mean, just it, in my mind, it kind of artificially creates a market because you have extremely low cost of capital, which then escalates the purchase price because the debt service is still very manageable. But in any case, the point being is that I feel like your model there is kind of more built for something that can withstand a dip in the market, whereas a lot of these, that were buying interest only, loans when the market was compressed are are not able to hang on right now, and
mhm.
that's
Yeah.
encouraging.
I think it's also, there's sort of a little bit of luck too, and time of start, right? So I think if you started post financial crisis in the business and you had, not been through ever a down cycle and you went into the 2020, 2020s and you saw all this debt and you said, hey, you already have five, a lot of units and you have scale and you have, the ability to raise money. Well, that, from their perspective, probably they're like, hey, now's the time to take advantage, right? Like, money is cheap. That, I have this great reputation. I bought all this property. I've done so well, and figured all this stuff out. And then, I think, people definitely, there's a lot of people who kind of got overwhelmed by they ended up concentrating so much of their book in a very short amount of time, and then that vintage just didn't work out that well for not reasons, reasons that we know, but vintage diversification, really thinking about when you're buying deals, how you're capitalizing them, and staggering that across your book can help, mitigate some of that risk because we took out bridge debt. We took out bridge. It was the only way to get deals done because bridge debt, really should be used for deals that can't qualify for stabilized financing. But everyone started using bridge debt as a vehicle just to pay more price, right? It was a price solution, not this property is unstable. It's like, hey, this property's full, but I'm still going to buy with bridge debt because agency financing, I can't compete. I can't provide the returns to the investors where investors were demanding, projected returns that don't match full cycle performance for real estate. So you had to go with, higher leverage in order to clear the market. And that was the mentality, right, of the marketplace. And then if you were really successful, it's like Icarus, they just went a little bit too close to the sun and then they fell and that was that. And so, we were lucky that we started not as early as that, hadn't bought as much, didn't have as much of an investor base, and didn't, and we were also, students of, margin of safety and the finance, traditional finance. And so we were always thinking about long-term interest rates, not short-term interest rates. So we want to make sure our long-term cap rate exceeds our long-term interest rate, not our today cap rate, exceeds our today interest rate. We know that all that stuff's going to change. And so we really looked at that kind of, again, from the long view, from a long time scale, knowing we're going to hold this for 10 years. We need to know what is our average cost of capital, not just what it is today. So I think people, some people certainly did it in a way that was maybe malicious or, ended up ultimately doing it in a way that was fraudulent. But I think a lot of people just got, caught up in the frenzy and, just like people do in the equity market today, right? I mean, the equity market just keeps going up, up and up. We'll see how long that lasts.
Yeah. Now, the cycles are, I think there's a lot of clarity in hindsight, but not everybody understands them when you're in them or
Yeah.
where it's
Fog of
going. So,
war.
yeah.
Fog of war,
Yeah.
yeah.
Hey, Michael, if we could, I'd like to shift gears here for a second.
Sure.
As I mentioned to you earlier, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize, we look to see if we can transfer. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your investors, could be the Fed, lenders, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Michael Pouliot, what is the biggest risk?
The biggest risk as it relates to property, right? Or, the property business. So yeah, the first thing I thought of was I think the biggest risk is, really having strong operations, honestly. And then that kind of comes back to your people, your process, and your technology. And so really, property management, managing assets. Although, yeah, obviously we raise capital from individuals or institutions to buy these properties. Day to day, our life is about managing, property, and it's, day to day property, and then also the business plans and what we've promised investors and the business plan that we struck when we closed. And so the as you continue to grow the business, you need to continue to grow as a business leader, and then so do all your people. And so that I think is your biggest risk is getting to getting growing too fast. Potentially, or just allowing having operational systems that just are not equipped to handle the stage of your company. And I think that can happen very quickly, that those things can fall out of lockstep as you grow, or as, you just don't take, you take your eye off the ball sometimes. And so I think it's really important to make sure that you've got people who are focused on the day, people who are focused on the week, the month, the quarter, the year, and the decade. You don't have to have that many people focused on the decade, but you should have someone or a couple people who are, just so that we know where we're going. That way, the business can grow in a sustainable way, with a good culture. People like working there. And I think that's the biggest risk over time to generating or creating and sustaining a business, is having a good culture. People are thriving and they feel fulfilled, they can grow. And if you provide that, then you don't have to you don't have to be the hero. You don't have to always jump in and help with things. In fact, doing that actually hurts, the ability for the business to be successful. We were talking about our children before we started here, and it's not unlike a child. It's like you can't always step in and tie the shoes. Just, it's okay if we're we'll just be 5 minutes late. We'll just work on this, and then you'll learn the skill, and now you can tie your shoes. And so I think there's a patience and a willingness and a space to take risk and make mistakes, and all of that is kind of in that culture realm, which I think is, probably, I think, the biggest risk in property.
No, that's a great perspective, and definitely having the people and people skills and their ability to perform that's all good. That's good. Hey, Michael, where can the listeners go if they'd like to learn more or connect with you?
Sure. Yeah. Thanks for asking. So I am sporadically on LinkedIn. So, I have a profile on LinkedIn. You can put a message to me, and I probably will get back to you in about a week or so. It's not something I'm there every day. Otherwise, my email is michael@carboncrei.com. Or if you want, you can go to our website, investwithcarbon.com. We got a newsletter. You can join our mailing list. We do quarterly webinars on the market that I lead, as well as we also have a podcast that I do interview style, as well as bring on my partner. We talk about operations. So, and that's called the Deal Flow Podcast. So any of those ways is a great way to connect, and I look forward to chatting with anyone who wants to talk.
Awesome. Well, Michael Pouliot, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Excellent. Thank you so much. It was a pleasure to be here, and yeah, I'll see you again soon.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.